If you study profit and loss statement of a company and see a profit margin of 10%, how would you rate that company? Is that company performing well or not? And the answer is you cannot. There are so many different metrics that you need to study before you can confirm the financial health of a company. These metrics are sometimes also referred to as ratio analysis. To understand it better, we will separate ratios into four categories: profitability ratios, balance sheet ratios, leverage ratios, and growth ratios. Profitability ratios. These ratios tell you about the profitability margins of the company. But before we start studying these ratios, let's first have a look at a generic profit and loss statement. It starts with sales, then you subtract cost of sales from it and you get gross profit. Then you subtract admin and selling expenses and you get operating profit. Then you subtract other expenses, financial costs, add other incomes and you get profit before tax. When you subtract tax expense from it, you get the profit after tax. If you divide gross profit by sales, you get gross profit percentage. Similarly, if you divide operating profit by sales, you will get operating profit percentage. Same goes for profit before tax and profit after tax. Then there is EBITDA percentage or EBITDA margin, which is calculated in the same way. EBITDA is earnings before interest, tax, depreciation and amortization. Higher the profitability ratios, the better the company is performing. EPS means earning per share. Every company has a certain number of shares which are owned by the different people, which makes them the owners or shareholders of the company. If you divide profit after tax by number of shares, you will get the EPS of the company, which represents how much profit the company has earned on each of its shares. Then there's ROE, return on equity, which is calculated by dividing profit after tax by total equity. It gives you the percentage of company's profit in relation to its equity. ROA, return on assets, is calculated by dividing profit after tax by the total assets of the company, and it gives the measure of company's profitability relative to its assets. Again, the higher, the better. Balance sheet ratios. Assets turnover ratio. It is calculated by dividing company's sales with its total assets. It measures the value of company's sales relative to the value of its assets. This ratio is used as an indicator of the efficiency with which the company is using its assets to generate sales. Fixed asset turnover ratio. It is calculated by dividing sales with fixed assets. Current ratio is calculated by dividing current assets by current liabilities. It determines company's ability to pay its short-term liabilities, so the higher the better. Debtor turnover days. These are calculated by dividing debtors by sales multiplied by 360, that is the number of days in a year. It measures how quickly cash is collected from debtors. Payable turnover is measured by dividing trade payables by cost of sales multiplied by 360. It calculates the number of days taken to pay the suppliers. Inventory days are calculated by dividing inventory with the cost of sales multiplied by 360, and it tells the number of days the company holds its inventory before selling it. The lower the better, ensuring fast turnaround. Leverage ratios. Leverage ratios are related to borrowings taken by the company. Debt to equity ratio means the percentage of company's operations being financed through borrowed money. It is calculated by dividing total debt with total equity plus total debt. Net debt to EBITDA ratio. It measures a company's ability to pay off its debts. It gives an indication as to how long a company would need to operate at its current level to pay off all its debt. The formula is net debt divided by EBITDA. Growth ratios. Growth ratios tell you about how much a company has grown over the years. To calculate growth ratios, you measure the increase or decrease from one year to another in terms of percentage. You can calculate growth ratios of revenues, expenses, or profits.